Good morning, and thank you for joining KBRA's private credit webinar. While all attendees have joined in listen-only mode, we encourage you to engage with our speakers through the Q&A feature on your control panel. Ratings and additional research, including our recent private credit report, Minority Interests in JV Structures Through the Looking Glass, can be accessed through the QR code on your screen. Our market-leading private credit insights are conveniently located on our dedicated microsite, which is accessible at kbra.com. Should you have any additional questions on the topics discussed today, we are always available for a follow-up call. Now I'd like to hand things over to our moderator, John Hogan, for introductions.
Thank you very much, Caitlin, and thanks to all of you in the audience for joining us today. We appreciate your time. My name is John Hogan. I'm a Senior Managing Director in KBRA based in our Dublin office. We have a really interesting topic for this webinar today, and I'm joined by two colleagues from New York, both experts in this field. I'll hand over now to Andrew and then Judah for them to introduce themselves.
Thanks, John. And good morning, everybody. My name is Andrew Giudice. I'm responsible for the corporate project finance and infrastructure teams here at KBRA.
Hey, good morning, everyone. My name is Judah Gross. I am a senior director here at KBRA, and I work on the ratings legal team, supporting the corporate group as well as the funds group.
Thanks both. So today's webinar was really prompted by the feedback and interest we got following the publication of a private credit report we put out about a month ago now. The title of that report was Minority Interests in JV Structures Through the Looking Glass, and it focused on a part of the private credit markets that's really gathered momentum in recent years. I'm thinking here of transactions that are centered around a minority interest in a corporate JV. That minority interest is typically quite heavily structured. It's got a range of protections and other features. They're all aimed at bolstering the cash flows paid out to the minority shareholder. But if you step back, the starting point is typically a stream of payments through from the corporate sponsor into the JV. And that's what we were getting at with the title of the report. Once you navigate the complexity and the detail of the structures, once you pierce or look through the looking glass, the credit story is often pretty straightforward. Hopefully that helps set the scene. I'll turn over now to Andrew and Judah for some more background. Andrew, I'll start with you. Can you give us an overview of why companies are doing these transactions? What are the reasons that might prompt them to pursue a minority stake JV?
Sure. At a high level, companies are using minority stake JVs to unlock capital while retaining control. In most cases, a company contributes a valuable asset or a group of assets to a newly formed JV and then sells a minority interest in that JV to an outside investor, which is usually a private equity firm. Proceeds from that sale come in as equity, which strengthens the company's balance sheet, enhances its liquidity, and creates room for strategic flexibility. But from a financial reporting perspective, because the company retains majority control, it's usually classified as equity rather than debt, which avoids added leverage. This approach is especially attractive in today's environment, where many companies are focused on deleveraging, protecting their ratings while still needing to fund growth, refinance debt, or pursue acquisitions. We're also seeing companies use JV structures to finance asset acquisitions, so not just monetizing existing assets. In these cases, the JV is formed up front to purchase a strategic asset, allowing the company to share risk and preserve liquidity while maintaining operational influence and ultimately long-term upside. So ultimately, it's about raising capital without losing control, maintaining financial flexibility, and sometimes positioning for future reacquisition through options or staged buybacks.
That's great, thank you. And that gives us a really good sense of, the motivations for the corporate sponsor. What about the investors on the liability side? What's in it for the private credit investors that have the rated debt backed by the minority interest?
Yeah, so we've been seeing a huge demand on the minority interest side, which have been, as I mentioned, mostly private equity investors. And the big draw there is the opportunity for them to earn higher returns than you would typically see in traditional investment grade markets. So without taking on full high yield risk, they're getting similar type of returns. These deals often sit in the middle ground between investment grade and high yield, at least from a returns perspective. They're backed by a strong corporate sponsor, who's usually investment grade, and the deals are structured to provide predictable cash flows and still offer a meaningful upside. So the structure is a big part of the appeal, Investors are relying on contractual payments from the corporate to the JV, and those payments are usually protected by tight controls, limits on leverage, asset sales, spending, and so on. So that adds a layer of confidence that the cash flow will be where it needs to be to ultimately service debt at the minority shareholder level. What also helps is that the debt often comes in with preferred returns or step-up features, which boost yield even further. So you're getting that in a deal that's usually tied to a high-quality investment-grade anchor, which are really attractive returns in this environment.
Right. And I guess it's another example of the illiquidity premium being harvested in private credit. Judah, turning to you now for a second. We've seen these structures executed across a variety of sectors. Can you bring that to life for us a little bit and give us an example or a flavor of the kind of sectors you've seen involved?
Sure. And, as you said, we have seen it across multiple sectors and with, different assets. So, high level, a few examples. We've seen in the home building sector with the real property assets. We've seen it in the media and entertainment sector with IP assets, to include brand licenses or music royalties. We've seen it in the oil and gas sector with pipeline assets, aviation, engines and spare parts. We've seen it in, I think metals and mining also we've seen it. We've seen it in tech and packaging. And we've also seen it with some assets that are more project finance-like assets as opposed to more corporate-like assets. So I think that, the variety of different sectors, speaks to the fact that it's not so much the particular sector that's driving these structures as much as the structure.
Yeah. Okay. And perhaps serving a common need for those corporate sponsors as well in terms of, addressing balance sheet drivers, as Andrew mentioned. Andrew,
Absolutely.
Coming back to you, Judah kind of walked us through a variety of different sectors and underlying assets. If we think about it through the lens of ratings and the rating analysis, how does that breadth show up in terms of the different rating methodologies that we might employ?
Yeah, sure. So it's actually one of the strengths of these particular structures. We can broadly apply it across various sectors. We've seen it used, I think, as Judah mentioned, in semiconductors, energy, aviation, and real estate. That said, it's especially well suited for project finance-like structures. So where there's an asset that is generating predictable cash flows that are contractually linked to a third party. And this is where the project finance methodology often comes into play. In these cases, the JV may house critical infrastructure, and the corporate sponsor may agree to make contractual payments to retain access or usage rights. We've also seen companies pledge assets, critical assets, to a JV, and then those assets independently will be generating revenue, but the corporate or the anchor will then agree to basically backstop a minimum amount of revenues from those particular assets. So from this perspective, it's more of a corporate type of analysis where you're just relying on the anchor's rating in order to make sure there's enough money flowing up to the JV to make debt service. So I think, any type of asset that could be pledged to a JV is the starting point. And then it's really what type of contractual framework is there? Is the JV being structured in a manner where it's looking more like a project financing, where it's producing something, and in many cases the majority shareholder is agreeing to buy a predetermined amount of production from that asset? Or is the asset, and that would be a project approach, or is the asset going to operate independently? So it's producing a product that's being sold to somebody else, maybe not the JV, then not the majority shareholder, but the majority shareholder or the corporate anchor is agreeing that it will produce a minimum amount of revenue, which then what we could do is look at it more under a corporate perspective.
Right, thank you. Could we bring up the presentation, please, in slide 5? What we're hoping to do now is sort of move beyond the background and context and drill down into a typical structure. So we have a transaction diagram that we'll refer to. And there it is. So there's a lot going on in this diagram. Maybe just before we get started, to highlight a few key points. Starting on the left, you can see the stream of payments from the corporate sponsor into the JV. In the center of the diagram at the JV level, this is where the minority protections come into play. Those are all aimed at safeguarding the cash flows received in by the JV, avoiding leakage, and then incentivizing, and in some cases outright forcing, distributions to the minority shareholder. And then finally, in the top right, you can see the minority interest distributions being used to pay down principal and interest on the rated debt. So to build on that, Judah, a question for you. So the idea here obviously is that the rated debt in the top right corner is anchored around this stream of payments over on the left coming from the corporate. Take us through the analysis here. What are you looking for when you're evaluating whether you can anchor the transaction credit back to the corporate? What is it that you look for to establish that linkage?
Yeah. So the first step is we want to make sure that within the JV, there's going to be sufficient cash to be dividended up. And if we are looking back to the corporate anchor and the default risk of that corporate anchor, there will typically be some sort of contractual relationship between the corporate anchor and the JV, which will provide for that cash or guarantee that if for whatever reason the independent operations of the JV are on it fall below certain predetermined business plans and the JV is not generating whatever expected cash it was expected to generate, the corporate anchor will, quote, true it up and top up that shortfall. So as between the corporate anchor and the JV, the particular nature of whatever contract that is, that again is allowing us to look back to the corporate anchor, really depends on what the asset is or what the business unit is that was contributed to the joint venture. So three quick examples. Let's say the asset sitting under the joint venture was an IP asset. So we've seen relationships as between the corporate anchor and the joint venture. That contractual relationship could be a licensing agreement where the asset stays under the joint venture, but for the corporate to continue to have access to that IP, the corporate will make a stream of cash flow payments from the corporate into the joint venture, and that will be sufficient, assuming step 3 and 4 of the whole transaction works, for the joint venture to dividend those cash payments up to the issuer, the borrower, to pay principal and interest on the debt. If the asset was a operating business unit, which sometimes it is, it may not be an asset like an IP, but it could be an entire operating business unit. Well, then we've seen the contractual relationship between the corporate anchor and the JV take the form of perhaps a services agreement or maybe even a purchase agreement. So if the asset is an operating business unit and maybe the end user of that business, that services business, is the corporate anchor, well, then that contractual relationship between the corporate anchor and the joint venture could be a services agreement where the corporate anchor agrees to make a stream of cash flow payments into the joint venture in exchange for benefiting from the services that the business unit that's housed under the joint venture is operating. Let's say the business unit under the joint venture is producing widgets. Well, then there could be some sort of purchase agreement, maybe with a minimum volume commitment where the corporate anchor agrees to make a stream of cash flow payments into the JV. The last, silo or type of contractual agreements we've seen are instances when the business unit or the asset under the JV is not necessarily tied to the operations of the corporate anchor, but maybe producing business by itself with third-party end users. In that case, the business unit, the asset under the JV, may have a certain business plan with certain expectations of cash to be generated through those operations, which allows for certain cash to come into the joint venture. But in order for us to tie that back to the corporate anchor, we need to associate that with the default risk of the corporate anchor. So in those type of contractual relationships, it may be top-up agreement or a guarantee agreement from the corporate anchor to the joint venture that if production falls below a certain threshold, if the cash generated falls below a certain threshold, the corporate anchor will true that up and make a stream of cash flow payments into the joint venture such that ultimately we are guaranteed from the perspective of the corporate anchor that the joint venture will have sufficient cash to dividend up and pay debt, principal and interest payments on its debt.
So one way or another, you have the recourse to the corporate. It's either a fixed stream of payments or there's something happening at the level of the JV and that's throwing off some cash flows, but you have recourse to the corporate to plug any shortfalls relative to a defined business plan or a target set of payments. And that allows the linkage back. We're also assuming here, obviously, that those payments in, when dividended out, will be sufficient to pay down principal and interest over time on the rated debt, and also that the sort of box they get dividended into, or just paid into rather, won't introduce any further risks to the structure. Which probably brings us, Andrew, to you. Jude has talked about the sort of payments from the corporate into the JV. What happens next? How do we get comfortable that the cash flows going in, or the relevant portion of those cash flows, will make it out the other side?
Yeah, thanks, John. That's a great question. And honestly, it's one of the most important parts of the whole structure. It's not just about the cash flow coming in. We have to be confident that the right amount of cash flow is coming out consistently and predictably, and enough to pay down the rate of debt. The way we get comfortable is by looking at the minority protections built into the JV. So these are contractual guardrails that prevent the majority shareholder, usually the corporate sponsor, from doing things that could disrupt the flow of funds. For example, there are often strict controls on how much debt the JV can take on, if any, whether it can sell or buy assets, or how much it can spend on operating or capital expenses without approval. In some cases, if the JV goes over a certain threshold, say for CapEx or OpEx, the sponsor is actually on the hook to cover these expenses, which adds another layer of protection. So ultimately, the goal is to ensure that cash coming in from the corporate, whether it's through licensing fees, lease payments, or top-ups, doesn't get trapped or diverted, and the minority investor share makes it up the chain as expected. It's really about building predictability into the structure. The cash doesn't just show up and sit there. It's governed, protected, and routed in a way that gives us confidence that it'll ultimately end up where it needs to be.
That's great. And actually, maybe just to draw on 2 points that came up from both your answer just there, Andrew, and also something Judah mentioned earlier. I think it's a really important point to draw out. It's a practical example, but I think it illustrates kind of the structure and the intent here. CapEx and OpEx is obviously something that may be incurred at the level of the joint venture. There'll be restrictions on that through the JV, but also to the extent there are excess expenditures beyond the business plan, a business plan that will generate the desired cash available for distribution. Except there are excesses beyond that business plan, you've got recourse back to the corporate, which is kind of back to the anchor again, right? They have to make up those shortfalls, or they're liable for those shortfalls. So it's the same risk. Judah made a point earlier on about, you know, the entity, the joint venture engaged in the production of widgets. And I think there's another interesting point there. In a pure corporate analysis, where we're applying, you know, our corporate methodology and the corporate linked obligation methodology, we would be looking to ensure that there's no production performance risk in that structure, so that there would be some form of take or pay where, you know, either the corporate is responsible ultimately for the manufacture of the relevant asset, or the corporate is just making the stream of payments, you know, and guaranteeing a certain level of purchasing, kind of almost regardless of what's delivered into it. So either it wraps the performance risk, or it sort of absorbs it through a payment undertaking. I think if there was elements of performance risk or production risk, that would then likely lend itself more to a project finance analysis where you can capture some of those risks. But again, it's about kind of ensuring that what goes into the JV in terms of those contracted payments from the corporate isn't going to be compromised in any way, isn't going to be subject to leakage or deduction of other expenses, which takes us on to the next step. The reason we're so focused on that is what comes out the other side is a distribution. It's a dividend. And maybe we could just bring the slide back up if that's okay. There's an element of discretion around the payment out of the JV to the minority interest shareholder. And that's quite deliberate in these structures. But the idea, you know, here, I guess this is the question, Andrew, we've sort of talked about preserving the cash that's in the structure. How do we get comfortable that the cash will actually, once preserved, once safeguarded, there in the appropriate quantity, how do we get comfortable that it will actually make its way out of the structure, that those dividends will in fact be made?
Right, and that's a fair question. So dividends aren't usually seen as guaranteed payments, so it's natural to wonder how we get comfortable relying on them. But in these JV structures, the dividend isn't just a hopeful equity return. It's the planned mechanism for moving cash up to the debt holder, and the entire structure is built to support that. So the way the JV is designed, the cash flows are highly controlled, and the dividends become the default path for distributing available funds. For starters, the governance framework around the JV is really tight. These controls mean there's very little room for the cash to go anywhere else. So if there is cash in there and the debt service obligation exists, the path of least resistance is to distribute it out as planned. There are also incentives baked into the structure that make the sponsor want to keep the payments flowing. A common one is a step up in the preferred return if payments aren't made on time. Basically, the longer the minority investor waits, the more expensive it gets for the sponsor. So that puts real pressure on the corporate to keep things moving as agreed upon. And then there are mechanisms like the dividend pushers or blockers, which are designed to align timing and ensure the money is actually distributed when it's supposed to be. It's not just if and when somebody feels like making a distribution. It's structured, it's incentivized, and in many cases, it's contractually expected. So, well, yes, the form of the payment is a dividend. Everything around it, from the JV restrictions to the corporate incentives, are designed to make the payment feel a lot more like a scheduled obligation rather than a discretionary payout.
Yeah, and kind of there's lots of provisions around this, but I kind of always go back to the practical point as well. Like once the cash is in the box, why would it stay in the box? But you know, that comes back to the earlier discussion where the focus is really on ensuring there's no excess expenses or leverage at the level of the JV, because that would obviously have a claim on the cash that would be senior. You want no senior claims on the target amount of cash. Therefore, the only way it can go is out. Okay, that's great. Look, what we've discussed so far, I guess, is essentially the going concern scenario, right? It's the stream of payments into and out of the JV that you'd expect in the ordinary course. And obviously the aim, as we've discussed, is that we would be aligning the likelihood that the payments are made out of the JV to the minority shareholder with the likelihood that the corporate anchor makes its required payments into the JV. But let's move beyond that and talk about default scenarios. Judah, question for you. Can you sort of walk us through how we think about recoveries in these transactions?
Sure. So KBRA's issue rating incorporates both the probability of default, but it also incorporates recovery expectations. And different structures account for, potential recoveries differently. So as part of our analysis, when assigning a rating to the rated debt, we want to understand in a default scenario, which essentially is a default scenario of the corporate anchor, how value will flow to the actual holders of the rated debt and what the recovery would be there. And we've essentially seen recoveries flow through three different paths, or potentially three different paths. The first most straightforward feature we see is a put arrangement as between the issuer, which we have over here, the green box on the right side, the asset manager's acquisition vehicle that issues the debt, and the corporate anchor, the blue box on the left side. And in this scenario, if there were to be a default of the corporate anchor, either directly that would allow the issuer to exercise the put, or maybe indirectly that would result in a default in the rated debt, which would allow the issuer to exercise the put. But ultimately, what we're looking for is that the issuer has the right to sell back to the corporate anchor its shares in the JV for a sum of cash that is sufficient to pay off the debt that has been issued by the issuer in the first instance. So in that scenario, even if the corporate anchor were to default, prior to maturity of the rated debt, then the issuer would be able to exercise its put, sell its shares in the joint venture back to the corporate anchor, receive a cash payment, or at least have a claim in the corporate anchor's bankruptcy for the size of a cash amount that is sufficient to pay off the rated debt. And if that were the case, that could be one avenue or path of recovery ultimately for the rated debt holders. A second path were to be, if there is not a put feature there, or for whatever reason the put feature wouldn't work because of sizing, etc., were to be the joint venture itself, its claim back into the corporate anchor on account of its contractual relationship. So as we started, the stream of cash flows, or the way we're really able to look back to the corporate anchor in the first instance, was because there's this contractual arrangement as between the corporate anchor and the joint venture. The assumption would be that in a circumstance of default of the corporate anchor, the joint venture may have a claim to some degree based on that contractual relationship, which, if there would be proceeds from that claim, that would go from the corporate anchor back to the joint venture, and that can be used to some degree to pay down some of the rated debt notes. The third path for recovery could be the assets themselves. So in these type of transactions, the assets that sit under the joint venture, they're often themselves pledged to the rated debt holders, and in a default scenario, the rated debt holders may be able to look to those assets themselves to achieve a certain degree of recovery. So again, that's three different paths of recovery, either through a put arrangement as between the issuer and the corporate anchor, or path of recovery through the contractual arrangement between the JV and the corporate anchor, or the assets themselves that sit under the joint venture.
And can you sort of walk us through how those different paths play out in terms of rating outcomes, or, you know, how do they get reflected in the analysis?
Yeah, and there's space for each of these three different paths to impact the ultimate rating quite differently. So let's start with the put feature. In the circumstance where, you know, upon an event of default, call it a bankruptcy of the corporate anchor, the issuer is able to put its shares in the joint venture back to the anchor. In that scenario, we would view KBRA, we would view the issuer to have a bona fide claim, an allowed claim in the corporate anchor's bankruptcy in the size of the amount of the proceeds of the put, which is tied again to the amount of the rated debt outstanding. So in that circumstance, we're not saying necessarily that the rated debt holders will be paid in full, because it'll be a claim back to the corporate anchor's bankruptcy, just like any other unsecured claim in the corporate anchor's bankruptcy. But at least the rated debt holders wouldn't be any worse off than your standard general unsecured creditor of the corporate anchor. So in that case, just like when we would rate the corporate anchor itself, the issue rating on the general unsecured creditors would typically be aligned with the rating, the issuer rating of the corporate anchor. We could do the same thing for the rated debt as well. We can equalize that. We can rate the issue rating of the rated debt the same as the corporate anchor, reflecting that the ultimate recoveries of the holders of the rated debt will likely see recoveries in line with the general unsecured creditors of the corporate anchor. Again, that's on account of this put feature. Now, that's very different than if the claim or the path for recovery is predicated on the claim the joint venture may have in the corporate anchor on account of its contractual relationship. That contractual relationship may not be a accelerated debt-like instrument like the put feature is, right? And therefore, it's unclear, or at least there's risk, that the claim the joint venture has back to the corporate anchor may not be, that allowed claim may not be sufficient enough to provide ultimately the rated debt holders with recovery to the same degree that general unsecured creditors would have directly within the corporate anchor, the direct general unsecured creditors of the corporate anchor. So for example, let's say the contractual relationship was a lease obligation or was a licensing obligation. There's nothing there necessarily that says upon a default, all future cash flow payments that would have had to be made under this contractual arrangement need to be paid off now, such that the joint venture would have that large claim size to the amount of rated debt outstanding, that the joint venture would have that claim into the corporate anchor. So in that scenario, we would probably and often do notch down the rating of the rated debt to reflect the fact that the recovery of the rated debt holders through this path of recovery probably would not be as in line with and as robust as the general unsecured creditors of the corporate anchor. What's important to note is this doesn't mean the transaction is not rateable. We would just notch it down. The third path to recovery we mentioned was the assets themselves that sit underneath the joint venture. And in that scenario, so let's say there's no put, or let's say we're unable to get to a certain comfort level that the claim the joint venture has back to the corporate anchor on account of its contractual arrangement would be sufficient to cover the rated debt. So looking to those assets, that can be an alternative third path for recovery value. And if our view is that even in a distressed scenario, those assets would retain value such that the ultimate recoveries of the rated debt holders would be similar to that of the general unsecured creditors, we'd be able to align it, even if there was no put feature, or even if the claim under the contractual arrangement between the corporate anchor and the joint venture wasn't as robust. It could very well be that if the assets underneath the joint venture were so valuable, and we believe that in a distress scenario, they would retain that value such that we thought the rated debt holders would ultimately see a better recovery than those of general unsecured creditors at the corporate anchor, we could potentially even notch up. And alternatively, on the third end, if for whatever reason we thought those assets would not retain value in a distress scenario or not be available because of structural implications, et cetera, then we potentially could continue to keep it notched down because of our view that the ultimate recovery for the rated debt holders would be less than the general unsecured creditors of the corporate entity.
That's great. Thank you. Thank you, Judah. And I think one thing that's worth sort of underlining from that sort of outline you gave us is that when you're looking at a stream of payments under a contract, so this is not, and this is the point, as it says in the slide, it's a contractual payment obligation. It's not a borrowed money obligation. When you're looking at a stream of payments under a contract, they don't naturally accelerate in the way that like a stream of payments under borrowed money in terms of interest has an acceleration on an event of default where the full amount of principal is accelerated and becomes due. And that can drive some of the difference between alignment with the issuer rating or the corporate rating in a going concern scenario and some divergence when we think about recoveries in the default scenario. We've actually had a question from the audience that's on this topic. And I think the question was sort of centered around transactions where there is some kind of put. And I think it's safe to say a put isn't present in very many of these transactions. You see it occasionally. The put, obviously, as Judah outlined, establishes a fairly clear link to the corporate for principal recovery and supports aligning the rating through the sort of gone concerns scenarios as well, and through the recovery analysis as well. But you're absolutely right. That level of recourse will typically suggest that there's something, other motivation for the corporate for that particular transaction, and they're solving some other strategic or financing need. And I think, we don't really speak to the treatment necessarily from a financial perspective or an accounting perspective. We can't get into that, but I think, you're quite right. The sort of implication that was drawn out in the question, having that put in the transaction creates a stronger link to the corporate and is closer then in substance to sort of a debt obligation of the corporate, because you're sort of piecing it together in that way. There's a lot of nuance in this, though, so I guess it doesn't lend itself to black and white statements, but just to maybe respond to that question live. That's great, Judah, though, just to get your thoughts on recoveries, how they may play through the different structures, and how the rating outcomes can reflect the different structural features. There was also a question from the audience around what may change from a ratings perspective if there's leverage at the asset level. Maybe just briefly to speak to that, and I'll let Judah or Andrew weigh in if they want to add to it. But there are often cases where the joint venture owns an asset and there may well be some leverage at that asset level. The structure may be largely indifferent to that if the corporate anchor is always making good the joint venture. So in that kind of setup, the asset level, there's some leverage. The JV may be receiving a dividend up from that asset owning entity, net of that leverage. But any variability in those cash flows up into the JV are ultimately wrapped by the corporate through some form of support arrangement or top-up arrangement. So it's quite possible that there may be leverage at the asset level, and it doesn't sort of disturb or change the analysis, because regardless of what happens and how that impacts the flows into the JV, you still have, the payments into the JV from the corporate, and you can kind of rely on those and look to those. Leverage at the level of the joint venture will be another matter, though, obviously. I don't know, Andrew or Judah, if you want to add to that.
Yeah, John, I think you're right. And if I think about it from a that's 100% accurate if we have like a corporate type of structure. I think if you have a more of a project finance type of structure where the asset has leverage on it already, and we're looking for distributions that will flow up to the minority shareholder after debt service is made at the asset level, then it becomes similar to a holding company type of analysis in project finance. So what's the ability of this asset to generate revenue? What's its ability to make debt service on the project level debt? And then as money would flow up to the JV, so the JV is its ownership structure. So you could think about it as a holding company, as we normally would see. How much money is available there? And then we would have the normal type of provisions that we talked about on how money would flow up from the JV to the minority and majority shareholder. Now, it becomes a little more complicated, because if you're looking at it as the OpCo being a project, you need to understand in what situations where distribution tests potentially be tripped, and then there wouldn't be any money flowing from the project level up to the JV. So it's definitely possible. It's a little more challenging from a project perspective. I think that the way John talked about it from a corporate perspective, if we're really just relying on a support agreement, in many cases, we're not too focused on the asset because we could assume the asset doesn't generate any revenue. And then in that case, we're looking to, okay, what under the support agreement, how much money needs to come in from the corporate? And then that becomes a true corporate credit analysis. We're just looking to the anchor's credit rating. So I think it's a lot easier if there's an asset that's levered and we're looking at it from a corporate, as opposed to if it's an operating project that has leverage at the asset level.
Yeah, I think, Andrew, there, your further detail kind of highlights a couple of layers of kind of overlaps in some of these structures, right? Between what we're showing here on the slide, which is a sort of corporate finance solution provided by private credit, with sort of more OpCo, HoldCo structures, and also then the sort of overlap and the interaction maybe between structures that look like this but are corporate risk when you look through, and then others that have much more elements of project risk, and you're actually sort of doing that rating analysis, and hence back to the earlier kind of discussion around which methodologies may be employed for different structures. Just have one final question actually from the audience, and Judah, it's one for you on recovery. So we talked about the three paths to recovery. One, you may have a claim to the corporate, but it's a claim in respect of an amount due for their running or their sort of ongoing contractual payment obligation. You highlighted the potential issues that may arise there. Secondly, you may have a more straightforward claim to the corporate, and as we mentioned, that's closer in nature to a borrowed money type obligation, or at least a claim for principal. And then finally, you may have some recoveries for the asset. I mean, are there cases where like there's an asset involved, like we see here in the structure, but you don't always give credit to the recoveries for the asset? And if there are, can you kind of outline some of the considerations that might sort of give rise to that approach?
I mean, yeah. So we're trying to see what the asset or what asset value really is there at the point of default. So I think one thing that comes to mind was we spoke about the different operations of the asset. It could be operations with independent third parties, and that was in the context of the corporate anchor true up. But they could also be assets where really the end user of the goods or services produced by that asset are the corporate anchor itself. So if you have that scenario, and then the value of that asset is kind of tied to the ongoing operations of the corporate anchor. If it's a certain type of restructuring where the corporate anchor goes into bankruptcy, it could very well result in a material impairment of the value of the asset. So in that scenario, it could be it's a very well operating asset now, and the corporate anchor is a very fine and well operating company now, but looking to at a distress through a distress lens, trying to account for what recovery could come from this asset at the point of a corporate anchor default. If that was the case, it could very well be that the asset at that point has very minimal value to provide recoveries for the rated debt. And I'll say one other thing, as Andrew mentioned before, it's not so much about the asset, but looking back to the credit rating of the corporate anchor. That's true. But if that's the case, if we're really going to discount the asset, then in a recovery scenario, also, we kind of have to discount what the value of the asset is going to be, right? So it gets a little bit more corporate specific with respect to the asset if we need to look to the asset value at that asset to account for certain recoveries.
That's great. No, thanks for that. I think it's great to sort of draw out that detail. I think that's all we have. We don't have any further questions coming through from the audience. Thank you for the questions that were submitted. We have one more, and I think we can kind of speak to this fairly quickly. So the question is, if the corporate anchor is a non-IG company, can the rated debt still achieve an IG rating? And the short answer, and then I'll hand over to Andrew and Judah, is it depends. We have published in our research report the sort of distribution of ratings across the 24 or so transactions that we've rated. And we've also published something there that shows the level of uplift from the issuer rating as well. But I think, whether a sub-IG rating could be, or sub-IG corporate could be the anchor for one of these transactions, and you could achieve some uplift over that. As I said, I think the question is, it depends. And maybe I'll just stop there and hand over to Judah or Andrew to sort of add a bit more detail.
Yeah, John, I think you're right. I do think it depends on the credit quality of the anchor. It's unlikely if it's like a B type of corporate that you're going to get from B to investment grade. if you're double B plus, and we think that the recovery of the assets within the JV would be substantial, and we do think that there's a clear tie back to the unsecured. So the starting point initially is, what's our recovery prospects if we were just looking at the corporate in and of itself? If we thought we were on the same page as the unsecureds and the issuer rating was a double B plus, then that's our starting point. Then we would look at the assets within the JV, and if we think recoveries based upon just those assets would be 100% or higher, then it's possible we could lift the rating maybe a notch. So you potentially could go from double B plus to investment grade. But I think it's really challenging when you get down in the low double B or the B category, going from that anchor rating up to investment grade.
Yeah, I would just echo, it's in that scenario where we would go from non-investment grade to investment grade. It's not, at that point, it's not so much about structure as much as the asset value.
Right. Okay. I think we'll wrap up here. Thank you, Andrew. Thank you, Judah, for sharing your expertise, your insights. Thanks to everyone in the audience for your time, but also for your questions. If you have any other questions, please feel free to reach out to any of us here on the panel. We're happy to sort of follow up. Also, feel free to reach out to your BD contacts at KBRA as well. I think what we've heard today probably underscores that minority interest transactions are no longer niche, right? They're increasingly becoming a key capital raising and financing tool for corporate sponsors. We expect to see continued growth in this area. We expect to see more innovation in this area as well. And with that, we'll wrap up, and I'll hand back to Caitlin and Rose.